Jonathan, BHP, the London and Australia listed resources company, has come out and written down billions more, yet billions more, of the $20 billion investment it made in US shale properties some half a decade ago. Let me ask you a question. If you had been running BHP 5 years ago, would you have done better?
To be perfectly honest, I very much doubt it. In fact, I probably would have done something even more spectacularly stupid, like go and buy a bunch of US coal mines.
Or some German nuclear power stations.
I mean, on a serious note, I mean, it's very easy to sit here now and say, oh my goodness me, what were they thinking?
Yes.
But actually, sort of back in 2011, 2012, this wasn't such an outlandish move. Lots of people were piling into shale gas and oil. BHP is primarily a mining company, but it did already have and still does have offshore oil and gas assets in primarily in
So
Australia.
it wasn't a wild step out of its area of experience.
That's right, no. And the great attraction of shale particularly is that it offers very quick cash flow, and that's a big contrast to BHP's sort of traditional project, which is, you know, sort of spend billions developing, I don't know, iron ore mines in the west of Australia, which generate vast amounts of cash and profit over very long periods of time, but take a long time to do so. Shale is a quick buck because it's all onshore, it's all relatively easy.
So they, like a lot of the rest of us, they didn't anticipate that the global demand for energy and the global supply for energy wouldn't both go the wrong direction at the same time. The wrong direction, that is, for producers, of course. So they made a mistake a lot of other people made.
Yeah, I mean, you could argue that in 2011, 2012, it was very hard to foresee that the Iranians would come out of sanctions purdah and be sort of engaging in a pumping race with the Saudis. But I think the problem now that BHP faces is that, yes, these assets offer very quick cash flow, but they also demand a lot of care and attention. With shale, the wells deplete very quickly, so they're constantly having to be re-drilled. That's manpower, it's logistics, it's moving stuff around all the time. Yeah. With oil at $30 a barrel, that's a pain.
And you mentioned cash before, and cash is now an issue because this is a dividend-paying company. $6 billion of dividend goes out the door every year. They call it a progressive dividend policy. What do they do now? Do they cut the dividend? What are their options now that they're in a situation where they actually have to think about preserving cash flow?
Well, if they did have to cut their dividend, and the market is expecting them to do so, the comfort for them is that, of course, they would not be the first. So Glencore has already scrapped its dividend altogether for the next 2 years, and Anglo American has already cut as well. It does look like the dividend will have to go. The question, I think, relates to policy going forward. So mining companies, oil and gas companies, in fact, sort of UK-listed companies particularly, are very wedded to this idea of a progressive dividend policy, i.e. that it sort of either stays the same or goes up every year. BHP might be better served by moving to a sort of more continental style payout ratio, where you say, well, this is what post-tax profits are, and we are going to pay out a percentage,
a fixed ratio
of those profits.
Thanks.